Welcome back. I'm Vince Perryman, and you're watching Legalese. Joining us on our show today is CPA Gus Wilson. We're discussing tax preparation. Gus, before the break, we were talking about the energy efficient tax credits, those sort of things, and I know I'd probably cut you off before you were able to sort of summarize the issues with those.
Well, pretty much in summary, just two more points to make. One is that when you're claiming some of these credits, you really need to watch if you're self-employed and you use your office for any kind of business use. You can run afoul of some regulations that way. And then also there's special regulations for fuel cells as opposed to solar cells and wind reclamation. So you do need to be very careful about how you read the code. Once again, I know I can't say it enough. Check with your advisor, CPAs, attorneys, someone who can help you with your specific needs, because not everyone's need is just cut and dry, and these new regulations are very, very specific for very small percentages of the population.
Okay. And now I know one of the big things that we're hearing a lot in estate planning over the past couple of years has been this conversion of a regular traditional IRA into a Roth IRA. Can you speak to that?
Yeah, they've essentially made it a little bit easier to do. There's only a very small group of people who will probably benefit from this. You can probably speak more to that than I could, but I really think it's geared towards people who anticipate their tax rate to be the same or higher when they hit retirement age. And so what they're doing is just kind of a tax planning strategy. And remember that, in a nutshell, an IRA, a traditional one, is pre-tax money that you've received a deduction for, whereas a Roth IRA is post-tax money that will be non-taxable when you remove it from the IRA or the retirement vehicle. And so what the regulations are giving you an opportunity to do is to convert that money from a traditional IRA to a Roth IRA, pay the tax up front. They are lenient on the taxes. You have 2 years to pay it, 50% both years, and the first year that you pay it is 2010, second year is 2011. They made it easier by removing the cap. Essentially, I think it was $100,000, and now I think it's the sky's the limit. I think you can convert the whole thing, but just remember that there's significant tax effects both downstream and immediately if you choose to do this.
Yeah, one of the main things for the conversion that I'm telling people is if you're choosing to convert, what you want to do is to be able to have enough money outside of the IRA you're converting to pay the taxes on it. So that way you put all of that IRA into the non-taxable Roth category. Now, was there any other individual tax issues other than the home buyer credit?
There are, once again, the rules that were developed this year and the new regulations were very specific, named at specific groups of people. There's a whole slew of them. Most of them are, you're talking about, very small percentage of the population, but two I did want to cover are unemployment benefits. Obviously a big issue. We're still seeing double-digit unemployment, and times are tough all over. And so the government did allow the first $2,400 of unemployment benefits to be non-taxable. Everything after that, unfortunately, is still taxable. And then the last thing is the child tax credit. The eligibility on that, it has been increased, so more people do qualify for that child tax credit, which is a refundable credit, meaning that it can affect your bottom line to the tune of money in your pocket.
Okay. And then do you want to go to the home buyer tax credit, or do you want to go to the business stuff first?
Let's talk about the home buyer tax credit, okay, if we have time here. Just kind of a general overview in a nutshell is there's essentially three laws that have been passed against the home buyer's tax credit. The first one, I'm going to have to read from my notes here because it's tough, but the first one covers the time period from 4/8/08 to 12/31/08. That one is a $7,500 first-time home buyer tax credit. It is not it's not free and clear, to say the least. It is a 15-year loan, interest-free from the government, that you have to pay back. And so essentially you start paying $500 on your tax return in 2010, and you'll just keep paying until it's paid off 15 years from now, or if you sell the home, you got to pay it back then. And so people who bought a house, pre-12/31/08 who took this credit are not sitting as pretty as people who took who bought a home, one day later, and took the $8,000 credit that everyone's talking about. So,
now, on the sale of the home, where that triggers the full repayment, what if you're selling the home at a loss?
there are certain rules and regulations that provide, it's kind of like a stop loss, where if you're selling the home at a loss, you don't have to repay it given special circumstances.
Okay.
And it's kind of like a cap. It's like you got to sell the home at a loss, you sell the home at a break even, or sell it at a profit. And there's certain rules about how you have to repay that $7,500 at each tier.
Okay.
The next round of legislation covers the period from January 1st, 2009 to November 9th, 2009. And this is the $8,000 home buyer's credit. And this is the one that you keep on hearing about. It is a credit, not a loan that needs to be repaid back unless you sell the house within the first 3 years. And so make sure that you live there for a while, otherwise you're going to be repaying it. You can claim it on the 2008 return, but it's really, you're talking about a 2009 type transaction, so you can choose to amend your return, or if you hadn't filed yet, pop it in there. It does have some phase outs, $75K for single, $150 for joint. And then the next round of regulations is where it gets really, really hairy. And this is it covers the purchasing from November 9th, 2009 to May 1st, 2010. And if you have a contract standing at 4/30/2010, you can run all the way out to June as long as you sell the house by June, or move into the house by June. You can still claim the credit.
We've got a break, so when we return from our break, we'll talk more with Gus Wilson about tax preparation and specifically the home buyer tax credit.